The Korean Financial Crisis by Deanna, Kendall, and Julie.
Financial crisis arose because of government failure in two major policy areas, exchange rate policy and industry policy. These government failures set up the steps that led to the Korean economy to recess. The exchange rate policy failure occurred due to the government's attempt to peg the won, South Korean money, to the US dollar. To peg means when a country maintains its currency value at a fixed exchange rate to the US dollar. The South Korean government fixed the won to the US dollar, so when the US dollar was appreciated in 1997, so was the won. Because the US dollar was a flexible exchange rate, its appreciation was due to millions of individual investors judging its value to eventually improve. However, the won was appreciated simply because it was fixed to the US dollar, so it was significantly overvalued by financial markets. Therefore, the government's guarantee to maintain the fixed exchange rate led businesses to believe that the foreign exchange risk did not exist. Because of this, businesses did not consider the potential increase in the domestic cost of foreign debt, which occurred when the won eventually devalued. When the won lost its value, it became extremely difficult to repay foreign debt, resulting in South Korean banks and businesses defaulting on loan obligations, like the Great Recession. The Korean government's industrial policy also caused the crisis as financial institutions and business firms collectively made investment decisions on political grounds rather than economic grounds. This resulted in a lot of South Korean investments being uneconomic, ultimately hurting the economy. Overall, the Korean financial crisis was caused by the overvalued won encouraging excessive foreign borrowing and the industry policy of investing the loans for uneconomic purposes.
As Kendall explained, after the failure of the exchange rate policy and industrial policy, South Korea came very close to bankruptcy and business began to fail. South Korea was forced to turn to the IMF for immediate help. The IMF decided on a $58 billion bailout package, which included multiple structural reforms within Korea. The IMF required Korea to liberalize trade so that the government would control the economy less and the free market would become increasingly popular. Korea also had to liberalize their capital accounts, reform their labor markets, and restructure corporation governance. The immediate priority of the IMF program was to stabilize the foreign exchange market. To do so, they provided foreign exchange loans to commercial banks who were in need and forced interest rates to be high so that the public was encouraged to hold assets in domestic currency. The financial sector of the IMF's plan included suspending 14 merchant banks, placing 2 commercial banks under supervision, and requesting institutions to submit plans for capital restorations. In terms of labor market reforms, the program said that the scope for layoffs needed to be enlarged, which would be accompanied with improvements in unemployment insurance schemes and labor retraining programs. The IMF also tried to remove remaining trade restrictions so that Korea would be receiving money from foreign relations. Since the original plan, the IMF has reviewed the situation and strengthened the program 3 times.
After the IMF's intervention in South Korea, it had left many consequences on the nation, as there were many positives such as current account surplus, trade surplus, debt restructuring, and also the implementation of reforms which allowed 100% of foreign ownership of Korean-listed companies by the end of 1998. Keep in mind that prior to this reform, the IMF had asked for 55% ownership. Despite the benefits of the IMF getting involved in helping South Korea for the short term, there had been drastic drawbacks pertaining to the Korean government, their companies, and their labor. There was a result in high interest rates. The chaebol, which is a large conglomerate of firms, usually family-controlled, tended to have close ties with the government and influence. To attract any takers for their bonds, they had to offer them at interest rates up to 30% after the crisis. However, in November 1997, 3 months before the crisis, the interest rate was only 13%. Smaller businesses and companies had to suffer more as their rates had been doubled. Experts said that as many as 30,000 companies, small and medium, would go bankrupt in 1998, which was a 100% increase from 1997 and a 200% increase from 1996. Currency and debt burden. The currency crisis was not over even after the IMF got involved. The dollar to won ratio is about 13,000 to 14,000 won to a dollar. A year before this, it used to be 800 won to $1. The weak currency had given the chaebols an extra $8 billion on interest to foreign investors. The total Korean debt after the crisis was estimated at about $150 billion. This was much greater than the following regions: Indonesia, $130 billion, Thailand, $100 billion, Philippines, $60 billion, and Malaysia, $40 billion. Debt hit locals harder than ever, and local government debt had increased. Chief Corporate Analysis at KEB Smith Barney Securities estimated that 24% of listed non-financial firms had debt burdens that were equal to or worse than the ones that had already gone bust. Increased unemployment. There was a massive layoff that appropriately led to the increased rate of unemployment. The impact of the massive layoffs would be felt by the economy in the early summer of 1998. With no government welfare like in Western European countries, this posed a threat to the Korean public and the majority of the population. In May of 1998, the unemployment rate had already reached 6.5%, from 2.5%, which was before the crisis. Overall, the negatives of the IMF's intervention had outweighed the positives that it brought to the region.